So there are a couple of routes that we can take whenever we're trying to find free cash flow. Let's use the following equation. Free cash flow equals NOPAT, net operating profit after tax, minus the change in NOWC, which is net operating working capital, minus the change in NFA, or net fixed assets. So let's look at this one component at a time, go through it, figure it out, and once we have all of our information, we'll be able to find free cash flow. So first we need NOPAT. Well, NOPAT is defined to be EBIT, earnings before interest and taxes, times 1 minus the tax rate. We're given both of these. EBIT is 4,200. Our tax rate is 40%. So 4,200 times 1 minus 40% gives us a NOPAT of $2,520. Next, we need the change in net operating working capital, NOWC. NOWC represents the dollar value of your assets that were purchased with either debt or equity investors' money. So NOWC just represents the money that we raised from our investors, and we use that money to purchase assets, but we're only looking at the investors who gave us money that require some rate of return. That's what this whole free cash flow idea is about. And so the definition of net operating working capital is our current assets, so all of our current assets, minus the non-interest charging current liabilities. So basically we want to subtract those non-interest liabilities from our current assets because we're not paying interest on them. And net operating working capital, we're only looking at the assets that we do pay interest on. So that's the idea behind NOWC. Well, in 2009, our current assets were $6,960, and our non-interest charging liabilities were accounts payable and accruals. We just assume that these two things never charge interest. Accounts payable are things that we, like when we pay suppliers on credit, it's a short term enough that we usually don't assume that we pay them any interest. Accruals are things like deferred salaries, expense maybe to our employees, which again we assume we don't pay interest on. So we need to subtract these from our current assets. Well, again, our current assets in 2009 were $6,960. Our accounts payable were $1,200, and our our accruals were $960. So we subtract those two things from our current assets. That gives us an NOWC in 2009 equal to $4,800. Now we're looking for the change in NOWC from 2008 to 2009, so we have to find out what it was in 2008. Well, in 2008, our current assets were $5,800, our accounts payable were $1,000, and our accruals were $800. That gives us a net operating working capital in 2008 equal to $4,000, which means the change, which is the difference from 2008 to 2009, is positive $800. So finally, we need to find the change in net fixed assets. Well, net fixed assets is directly an account off of our financial statements. We don't have to use a formula to calculate it, and so we can just read off of our statements. In 2009, it was $6,000. In 2008, it was $6,000, which means we didn't change our fixed assets. We didn't purchase any new fixed assets over the course of that year. So the change in net fixed assets is zero. So now we can find our free cash flow. Remember, free cash flow is NOPAT minus the change in net operating working capital minus the change in net fixed assets. So our NOPAT was $2,520, our change in net operating working capital was $800, and we had no change in net fixed assets. That gives us a free cash flow of $1,720.